This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Puru Saxena joining us this morning from Hong Kong. Puru Saxena is founder and chief executive officer of his own wealth management in Hong Kong. Welcome, Puru.
Morning, Gordon. Pleasure to be here.
I really appreciate you joining us. I've heard you years ago many times on my friend Jim Paplava's show, and I've always respected your advice, so I'm really looking forward to talking to you here this morning. Puru, for people that aren't familiar with you and your background and your firm, could you just give our listeners a brief overview of your involvements?
Sure, Gordon. I've been in the business now for 16 years. I've set up my own boutique investment management firm 10 years ago. We are licensed by the Securities and Futures Commission in Hong Kong. We manage investment portfolios for individual clients, family offices, companies. We work purely on a fee basis. We run 3 strategies, which is our discretionary equity portfolio, which is a trend following momentum program, where we buy growth stocks, and we have a strict risk management system to get us out of each position if necessary. We also run a discretionary fund portfolio where we invest globally in various sectors and geographical areas which we think have potential over the next few months to maybe 2 or 3 years. And finally, we run a 3rd strategy, which is our discretionary blue chip portfolio, where we invest in some of the best businesses in the world, which have been around for many, many years, if not decades. And they've shown a remarkable consistency in increasing revenues, earnings, as well as dividends over the last 15, 20, 30 years in some cases. So this program is more designed for the person who's more of a buy and hold long-term investor, and somebody who's looking for slow and steady growth with a reasonable amount of income over time.
Are these available for Americans, Canadians, and Europeans as investment vehicles?
Yes, they are. Anybody can invest with us now. We have just set up a relationship with a new custodian which accepts new investors from all over the world, including Americans living in the US, and we are fully FATCA compliant, so we can do all the reporting as well.
You're FATCA compliant?
Our custodian is, yes.
Well, we've had many interviews on that. That's not an insignificant issue nowadays.
Yeah, I mean, our firm is in FATCA compliant, but the custodian that we do, they are FATCA compliant, and they can accept business from Americans living in the US.
Puru, we're here to discuss financial repression. Could you explain to our listeners what those words mean to you, or how you would define it, how you think of it?
Well, we've been through a huge financial crisis in 2008, which brought the world's banking system to its knees, and the housing market in the US was on its knees. It was the worst recession, if not a depression, which the US faced in a long time, and it affected Europe, it affected all the global markets. So rightly or wrongly, in my view, wrongly, the central banks decided to bail out everybody in sight by keeping interest rates to near zero and by launching quantitative easing programs, which is essentially bond buying or asset swapping, printing new money and buying bonds, toxic bonds from the banks, clearing out their balance sheets and making sure that the banking system survived. And in the process, they've held interest rates close to zero for a long, long time, not only in the US, but also in Europe and a lot of other countries in the developed world. And this is really penalizing the savers at the expense of the borrowers and the debtors, and especially hurting the people who are close to retirement or already retired, because suddenly their passive income, which they had worked so hard to build all their life, has disappeared. So, it's essentially a transfer of wealth from the savers to the borrowers and debtors, which has managed to save the banking system temporarily, but it's not really good for society.
After 6 years of zero bound, zero interest, and various forms of quantitative easing and rotation, what problems has it created in your mind? What is the fallout from it?
Well, the fallout is that everybody has become accustomed to being bailed out. Now there is no such thing as a bankruptcy risk, because everybody knows, especially the banks, they know that if they make mistakes, somebody will bail them out. The central bank will bail them out, or the government will bail them out. So it's basically reduced it's encouraged risk-taking, if you will, because at the moment people have been bailed out by the banks, the central banks, but in the future, in the next crisis, if something bigger happens, then I wonder who's going to bail anybody out, because the balance sheets of the banks are already so extended. And if you look at the QE initiatives, the QE, I always felt, was never really capable of increasing business activity, because this is not really a supply side problem, this is a demand side problem. When you've got households all over the developed world already choking on debt, the last thing they want to do is borrow more money. Even if you drop rates to zero or give them money to borrow, they're just not going to do it. So when people say, why hasn't QE caused inflation or hyperinflation? The answer is simple. Households in the West were in no position to borrow money, even at zero interest rates. So the aggregate demand for new debt or credit simply wasn't there. And by swapping assets, the central banks have managed to clean out the banking system, but they have not been able to ignite the risk appetite on the household level. And that's why, even after 7 or 8 years, only now has household credit in the US started contracting, and we are seeing some expansion, but it is really very low compared to the previous cycles.
Puru, living here in the greater Boston area and traveling around America, my observation is we have gutted the middle class. They are totally tapped out. They are hand to mouth, worried about jobs, worried about a real income, and real disposable incomes collapsing. And in a 70% consumption economy, which has traditionally been the engine around the world, I don't see the demand. I just don't see the demand growth. And when I look at various rates, demand is falling off. Are you seeing that? Well, you must be seeing that in Asia.
Oh, absolutely. Hong Kong 2 years ago was brimming with mainland Chinese tourists. And now, I can only tell you about what I see here with my own eyes. And retail sales in Hong Kong have dropped significantly because the tourists simply aren't coming. This is not just a problem in the US or Europe. This is a global problem. Spending is hurting everywhere. The middle class has been obliterated, as you point out. The rich have become richer because of the asset boom we have seen over the last few years. The savers have been penalized. So this policy of QE and financial repression and keeping interest rates near zero really has helped the elite of the world, the mega wealthy people who have had access to financial leveraging and who've owned assets. They are the ones who really benefit from this.
Where do you think it's leading? When you look at your crystal ball and out over the next year or two, what's your gut saying where this is? What road are we on right now?
Well, we are on a road of cleaning out the banking system. QE has never really been about triggering economic growth. In my view, QE has always been a backstop measure to stop the banking system from going bankrupt. The banks were in deep, deep trouble because of the loans that they had made out and the debt that they were holding on their balance sheets. And the only way to save them was to have the central bank or the government step in and take off those toxic assets of the balance sheets. So the QE, in fact, perversely has done exactly what it was set out to do. It's just that its motive wasn't really very clear in the media. The media said that QE is designed to help the economy and it's going to help the middle class. No. QE was designed to help the banks, and it has helped the banks, so it has worked perfectly.
Yeah, it has. You mentioned earlier about who's going to bail out the banks next time. My personal opinion is called bail-ins. And if we move to this cashless war on cash or cashless society where your money is really locked into the banking system because you have no other way of getting it out if you have no cash, which would allow negative rates, negative nominal rates. Question for you. We have $5 trillion in negative nominal rates currently trading on sovereigns trading around the world. What is causing that? What is the root issue with that?
I mean, the cause is the low growth economic environment that we find ourselves in, and also the deflationary pressures in Europe and Japan. historically we've seen that whenever an economy passes through an extremely low growth, sluggish environment where there is a lack of aggregate demand, and when you have deflationary pressures, long-term interest rates historically have always gone down. The tendency of long-term interest rates has been to drift lower in this environment, and long-term interest rates are usually set by the rate of economic activity as well as the real rate of inflation. At the moment, we don't really have much inflation, or at least reported inflation anywhere in the developed world, and economic activity is zero, or if not negative. So long-term interest rates at the long end of the curve, in my view, are priced appropriately. There is some froth there because everybody has just piled into this trade. And it also shows the fear people have in Europe. People have been worried about Greece for a long time, and a lot of the banks are very questionable. So the big money has been piling in to long-term debt in the Eurozone, and they're willing to lose money or pay the government money, funnily enough. But this is just a symptom of the economy that we find ourselves in, especially in the Eurozone.
Yeah, there's a level of fear when you're willing to take a loss just to be able to feel somewhat level of certainty you'll get your money back. And of course, a lot of that is the restrictions by portfolios or prospectives, etc. Puru, what should investors be doing then? Like, what should the average person be thinking about or concerning themselves about?
Well, you have choices, right? Cash all over the world is yielding next to nothing, especially in the developed world. I mean, over in Hong Kong, interest rates have been virtually zero for about 7 or 8 years now. America is the same. Throughout the Eurozone, we have the same problem. So, you have choices. You can either buy commodities, which have been in a downtrend for the last 4 years, precious metals, which have been in a bear market for the last 4 years. You can buy long-term bonds, but they're really fully priced. High-yield bonds, corporate debt, that also is extremely overvalued. So I think, in a funny way, the only game in town left is still equities. Equities are still doing reasonably well because we are in a slow growth environment. We are not really in a recession in the US at the moment, but growth is very slow. Some companies are growing their business at a rapid clip, not just in the US, but globally. So equities are still holding steady, and I think there is a reason for that. The reason is that the yield on the S&P is still bigger than the yield on cash, and you have earnings growth. So if you are looking to invest today, I would be overweight equities, and I would buy the equities of the developed world. We have been overweight the developed world for the last 3.5, 4 years now. We still think that America, Europe, and Japan are going to do well. We also believe that the stock market of China is going to do incredibly well over the next 12 to 18 months. So I would encourage your viewers to actually focus on stocks. And even though stocks are fully priced right now, if interest rates remain where they are for the next few years, then today's stock market may not look very, very expensive. This bull market could go on for as long as Mr. Draghi is engaged in QE in Europe and the Japanese are buying assets. And I don't think the Fed is going to raise interest rates this year. Our view has been that the Fed is not going to be able to raise rates because the economy is simply too weak. And if they do raise rates, it will offset all the work the European Central Bank is doing over in Europe. So I think short-term interest rates in the US are going to stay where they are for at least another year, maybe 9 months to 12 months at the very least. And that's going to be bullish for Wall Street. So I would encourage your listeners and viewers to focus on good quality companies in the right areas and hold on until the next recession. No doubt we will have another global recession and a big bust down the road, but we're just not there yet. And in the meantime, this bull market could go on for maybe 2 or 3 or 4 years.
I enjoy your optimism on this, but we're looking at every statistical measure in the market saying that it's, when I say the market, equity markets, and that degree the bond market is overpriced. We have so many divergences, which signal fear, which says, people have been stung in 2000, they've been stung in 2008. You're saying, forget it. It's still going higher because it's the only game in town. Am I translating that correctly?
Correct. Stocks are not cheap anymore, don't get me wrong. Stocks are fully priced. We are in six years into a bull market, so you're not going to get bargains. The problem I have with the bearish view at the moment is that bull markets tend to go on for longer than most people expect. That has been my observation. And just because a market is expensive, it doesn't mean that it has to crash. Expensive markets can become even more expensive. It's all a function of the risk-free rate of return available all over the world. And if you look at the risk-free rate of return in the US, which is the yield on the 10-year, it is negligible. So given where interest rates are today, I would argue that equities are fairly priced at the moment. They're not extremely expensive. And we've seen towards the end of massive bull markets all over the world in the past that stocks become absurdly priced. So, we could still go from a fair valuation, given where interest rates are, to absurd valuation in 2 or 3 years' time if the Fed doesn't move. And if you have continuous QE all over the world for the next 2 or 3 years, stocks could still go higher.
Yeah, we're actually of the same court, Puru, but we think there's a scare coming to the market, a fear. Call it a correction, call it a consolidation before we move on to even higher highs in maybe the wrong terminology, but almost a von Mises crack-up boom, as there's no other game in town, and the central banks are buying. Most of the agencies of governments are now moving their sovereign wealth funds into equities. There's a scramble because they're the only place that has real assets. They have brick and mortar, and they have dividends, and they actually have some free cash flow, even when it's impaired slightly with currency valuations. You obviously share that same view, or do you?
Absolutely.
Yeah.
Absolutely. Where else are you going to go? If you're sitting with cash in the bank, and if you're retired or close to retirement, and you've seen your cash yield absolutely nothing for the last 7 or 8 years, where are you going to get? What are you going to do? What choice do you have?
Well, actually, everybody's sitting in fear.
Yeah, people are afraid.
And they're afraid, and that shows in the velocity of money. It shows in everything else. But that sometimes, even if it's illogical, this is what can happen. I'm not giving investment advice, but I've been around. I've seen this so many times before. Even you can lose a lot of money for the wrong reasons, as markets just continuously, until you finally, there's no other way out on it. I want to change slightly, Puru. What's your feelings on gold and silver and precious metals as another alternative asset class? At least in U.S. dollars, they haven't done that well over the last 2 years.
Well, precious metals remain in a secular downtrend or a bear market. Precious metals topped out in 2011. We have been out of this sector for the last 3.5 years. We've been urging our readers and our investors to stay out of precious metals. I publish a monthly newsletter called Money Matters, and we have been bearish about the metals since early 2012, late 2011. We still think that we are in a multi-year bear market in the metals. I don't think that the dollar rally is over. I think the US dollar will appreciate from here over the next few months, because historically big moves in the currency markets don't end after 9 to 12 months. They've lasted for another at least 2 years. So I think the dollar has another up leg coming, and that will hurt commodities, that will hurt the metals. And today, where you don't have much inflation, or at least reported inflation in the developed world, and you have a very low growth, sluggish environment, where the economies are actually on the mend, I would say that metals will probably disappoint for the time being. I think equities are going to outperform metals over the next 2 to 3 years.
What messages are you taking to your subscribers right now?
I beg your pardon?
What message are you zeroed in currently with your subscribers?
Well, our message is to stay with the trend. We are trend followers, so we look at the direction of the market, and talking about the economy and discussing the economy is all well and good, but I always come back to the same thing, that what do you trade? Do you trade the economy, or do you trade the asset prices? Because you make money by buying and selling assets, not by buying and selling the economy. And frankly, bull markets in the past have always climbed a wall of worry. And even today, we've had a big run-up in equities in the US over the last 6 years. People are still quite skeptical. The retail investors still aren't really fully committed or in it. No, so I think, no, they're not. And that to me is a bullish sign, because usually at the end of the cycle, you have widespread participation from the retail investors. Everybody's bullish and euphoric. We really haven't seen that yet. So I think stay with the trend, ignore the noise. The price action is king. It always has been. And yes, prices can become inefficient and out of whack for a while. But if you have trailing stops in place and you have a risk management system in place, you don't really have to, succumb to the carnage when the bear market comes. So for us, we follow a risk management system. We have trailing stops under every single position that we own for our investors. And our advice is be diversified, buy the assets which are going up, avoid the assets which are going down. Don't think too much and have a risk management system in place and ride the wave and make money. And when the music stops, the risk management system will get you out into cash and you will be laughing when everybody else loses their shirt in the next bear market.
It sounds so simple.
Well, it is. People complicate it, Gordon. If you follow a risk management system and you follow it, strictly and you don't have any excuses, you're not going to lose big money because your stops will get you out. And for us, in our programs, we have maybe a 7 or 8% trailing stop on every stocks that we own. And if they stop us out, not everything that we buy is a winner. Our success rate is about 60-65%. So when we do make money with the trailing stops, we make a lot more than we lose. And when we do lose money, we just take the chips off the table, admit our mistake on that particular trade, and move on to the next thing. This way, we keep all the emotions out and keep all the psychoanalysis out and just try and do our job, which is to make money for investors.
Discipline, and you're trend followers. That's how you would describe yourself. Yeah,
that's correct. We follow trends on 2 of our strategies, and one is more of a buy and hold strategy for the long term.
Well, trend following has proven to be a very effective strategy for a lot of people that can do it correctly. Puru, what kinds of advice would you give investors right now generally? And I say that in the context of internationalization. Looking at you said diversification, very, very important. But diversification has an element of internationalization. Being in Hong Kong, being a global person, how should they approach it? What should they think about?
Well, you have to have exposure to global equities, I feel. America did very well for a long time, but the pace of appreciation in the US is slowing down now. And the European stock markets have done better than the US since January when the QE started in the Eurozone. And China has been on fire. It has been our preferred market since last October, November. We still think China is going to do incredibly well over the next 12 to 18 months. Mm-hmm. In the last bull market, Gordon, the Shanghai Composite went up over 500% in 2 years. It was at 900 in October 2005. It went up to 6,124 in October 2007 in a straight line. This time around, we've appreciated by maybe 130, 140%. And I think there is more room to run here in China. So if your viewers and listeners are in the US, no harm in allocating maybe 10-15% of your overall portfolio to Chinese A shares. You can buy ETFs which trade in the US, which follow the A share market in China in dollars. So you can do that at the comfort of your home from your US stockbroking account. I would also look at some European equities. You can buy exchange-traded funds in the US which buy European stocks, and they are hedged in dollars. And I think the dollar is going higher and the euro is going lower, so you can hedge your bet in Europe. And also you can focus on some blue chip companies which are showing growth in the United States. And if we are in a rising dollar environment, then the business which operates solely in the US, they will do well because they get all of their revenue in the strong dollar. So, stuff like Home Depot, Costco, some of the big companies, FedEx, all these blue chip companies, I would buy those and just hold them, because if the economic environment improves even mildly in the Eurozone over the next year or two because of QE, then it is conceivable that these blue chip stocks in the US will do quite well. So I would focus on quality. I would avoid the speculative garbage at the moment. And if you look at the equity market right now, the mid caps are doing very well. The growth stocks are doing very well. If you look at the Russell 2000 Growth Index, that has actually been an outperformer for the past several months. And that to me is a sign that we are not close to a big bear market, because during the latter phases of a cracker boom, as you call it, things are big money, institutional money gravitates towards the defensive and safety of the defensive stocks, and it shies away from the mid caps and small caps. But this time we are seeing the reverse. We are seeing outperformance by the small and mid caps and also growth stocks, and that to me is an indicator that we're not near the end of this bull market or the start of a prolonged bear market. My view is that we're going to get the next big bear market maybe 2 or 3 years down the road. So you still have maybe 24 to 36 months to profit from the uptrend in equities right now.
Puru, you're refreshingly optimistic, but what possibly keeps you up at night worrying? What are you actually worried about?
There's so many things which can go wrong, Gordon. you could get a bankruptcy in one of the big banks. Greece could leave the Eurozone tomorrow. China could have some serious economic problems because of the slowdown in housing. So there's plenty of stuff to worry about, but that doesn't keep me awake at night because I follow a strict stop-loss system. I know if things go wrong, I'm going to take maybe an 8 or a 9% hit on my book, and then I'll be in cash. And if the S&P drops 30 or 40, 50% after that, well, bad for the others, not really so bad for me and our investors. So I don't, to be honest, worry too much about things because I only worry about things which are in my control, and I don't worry about things which I have no control over.
Right. A disciplined approach with clear stop losses, knowing what there are when you go in. Do you ever worry about liquidity in being able to clear out?
No, I don't. Because we only trade in the liquid stocks. We have a rule that we never buy any company with less than $1 billion US dollar market cap and good liquidity and volume for us to be able to get in and out. Mm-hmm. So I am not concerned. Of course, you can have flash crashes and stuff like that. But I don't believe that we will get to the point where there is no volume. Because if there is a crash, with all the high frequency traders and the algos churning the markets these days, there will always be liquidity to buy and sell. So I don't worry about that.
Great discussion, Puru. We're up against our hard line. Any clear message you'd like to leave with our listeners?
Well, I would say this, I would say that I agree with the gold bugs in the sense that cash is not a viable asset to own for the long term because it is being printed and debased all over the world. But where I digress from the gold bugs is that gold is not the best asset to own in this environment. Gold and silver have tended to do well as a fear trade when things have been bad, like they did in the last decade when the economies came to their knees, and gold and silver had a fantastic run, and we were bullish gold and silver from 2001 up to 2011 end. But now is not the time to park the majority of your cash in precious metals, in my view. I believe that over time, good quality companies, businesses with cash flows, revenues and profits and genuine products and services to sell all over the world, they will outperform precious metals by a wide margin. Productive assets do better than metals over the long term. History has shown that by a significant margin. So I'm not saying that your viewers and listeners should just dump all their precious metals. If they are inclined to hold some, I would keep some as an insurance policy in physical metal, maybe 10% or something of your net worth. And the majority of that other money, I would buy maybe investment real estate or even equities in good businesses until the next recession. When the next recession comes, all bets are off, and you have got to liquidate everything and go into cash or long-term government bonds. But I wouldn't worry about that quite yet. I think we still have another maybe a couple of years before this party ends on Wall Street.
Puru, can you tell our listeners how they can follow your work, your writings, and know more about your firm?
Sure. My website is www.purusaxena.com. You can go onto our website. We have a section called Portfolio Management, where we list out the 3 strategies that we run, and the performance of all of these strategies is on there. And as I've said, we can accept business from investors living in North America, whether they're North American or not, or even Europeans. We can get business from all over the world. So if you're interested, please do contact us. And in addition to the money management service, we also write a monthly newsletter called Money Matters, where we talk about all the trends in the financial markets. We cover equities, bonds, currencies, metals, and commodities in each issue. And subscribers also receive a weekly update every Friday covering the market action, and we highlight some of the sectors, the industry groups, as well as the geographical areas which look interesting to us, which have potential for capital appreciation over the next 12 to 18 months. And Money Matters is available by subscription online from our website. You can go on there. There's a recent issue there of Money Matters as a sample. You can read through that, and if you're interested, you can use your credit card and subscribe to the newsletter from the website.
Puru, an absolute pleasure. I've listened to you many times over the years back from the days of the .com, and seldom have you been wrong. So I need to tell our listeners that you've got a great track record, so I compliment you.
I do get it wrong, Gordon. I do get it wrong, believe me. Nobody gets it right all the time. The key is to get out and know when you're wrong and pull the plug, and not get a small loss get bigger. That's the key.
Exactly. Well said. Puru, we have to have you back. It's going to be an exciting 2015 and get some more ideas from you. Thank you for your time tonight.
My pleasure. Thank you so much for having me on your show.
Talk to you again. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.